Now we are going to learn about how to maintain the capital accounts of the partners. Now first of all we will learn how the capital used to be increased. Now in the sole proprietorship we have learned about that when the capital opening capital is there, when additional capital is brought, then it increases the capital. If salary is given, then it increases the capital. Then interest on capital is allowed, then it increases the capital. Salary or commission is given, then it increases the capital. So this way, these are some of the items which increases the capital account. But at the same time, when there will be a withdrawal, it will decrease the capital, and when there is interest on drawings, that also will decrease the capital. So this way capital can be increased or decreased, but we have to prepare that in the form of accounts. So there are two methods of maintaining the capital account of partners, and they are, first is fixed capital method and another one is fluctuation capital method. The difference between these two lies whether or not transactions other than addition and withdrawal are recorded. So we are going to learn about fixed capital method and fluctuating capital method. First we will be highlighting on fixed capital method. Now under fixed capital method, capital invested by each partner remains fixed unless a partner introduce additional capital or permanent withdrawal of his capital. So in this partner fixed capital method, there are two accounts to be prepared. First account is partner's capital account and another one is partner's current account. Now what is the role of partner's capital account? It will be transferring the opening balance and it will be having a closing balance. It will be same as ledger only, but here there will be a name of our partners X, Y and Z. Same way on the credits are also X, Y and Z. At the same time opening and closing balance will be transferred. If there is additional capital introduced, then they will be transferred on the credit side, because journal entries will be passed as cash/bank account debit to capital account. And if there is a withdrawal against capital, that is permanent withdrawal, if in the sum is there, then it will be transferred on the debit side, but it should be permanent withdrawal. Then the entry will be partners capital account debit to cash/bank. So this way this can be transferred. Then all the other items, like we have to prepare partners current account. Current account also contain opening and closing balance. So opening and closing balance will be transferred here. Closing balance, opening balance, opening balance, closing balance, that will be transferred in the same way as we have learned. But current account may have debit balance also, credit balance also. So here we will see on the both the sides by balance brought down, that is opening balance, then it will be only closing balance either of the side of the sum. So it may be the chances that it may have opening and closing either credit balance or debit balance. But partners capital always have, if fixed capital is there, partners capital always have a credit balance. Now switching towards the items which is to be transferred, that is interest on capital increases the capital, so credit side. Commission increases the capital, credit side. Partner salary increases the capital, credit side. And profit and loss appropriation, that is your profit which is transferred from profit and loss appropriation, also on the credit side. While on the debit side there comes drawings, that is drawings against profit. So there are, you may have come across, there are two types of drawings. Drawings against capital, that is permanent withdrawal of capital. Permanent withdrawal of capital is also termed as drawings. And another one is drawings against profit. So that is a normal drawings which is withdrawal every month, every year or any of the day of the financial year. Then interest on drawings is transferred. If there is a loss, then loss will be transferred on the debit side. And then comes next fluctuating capital method. Now under this fluctuating capital method, all the transactions are recorded in only one account, and that one account is termed as partner's capital account. Now it may have debit balance or it may have credit balance. So they may be having opening debit or credit balance. It may be either of these side. Apart from this, again same, whatever was coming in the current account, that all will be transferred in the partner's capital account itself when we are maintaining the capital by this method. So this way your partner's capital account will be completed. When the sum will start, you will understand more clearly about this. This is just for reference. When you will draw this in the notebook, you will have a more idea about this. Now we are going to have a formula for finding out the interest on capital. Now interest on capital is equal to amount of capital multiplied by rate of interest multiplied by time factor whole divided by 100 multiplied by 12. Now under this, when we have to take a note of these points. First, when partnership deed does not exist, no interest on capital is to be charged. When partnership deed exists, in case of loss, no interest on capital is to be charged. In case of profit, interest on capital is to be charged as per the rate of interest given. In case of interest on capital is more, then net profit is to be adjusted as per the proportionate interest on capital to be charged. When interest on capital is to be charged against profit, mention in the sum whenever the interest is to be charged through, though it may be loss. So these are three particular points which is to be remembered while doing the sum respect to interest on capital. This explanation can be more in detail when the sums will be there. So we will continue with that later on.